Very, very briefly, our next speaker is Gyongyi. Gyongyi has an amazing portfolio of experience. She's extremely passionate about investments. I had the opportunity to work with her at another event earlier in the year, and she gave me a long list of her passions and her hobbies and all of the things that she likes. I won't share all of those with you at this point in time, but if you see me during the break, I'll be free and happy to share those with you. She's the mother of 4, one girl in there, and therefore her immediate obligations are to manage stress and convert that into courage. In her spare time, she likes to manage investments, so she literally takes her work home in most respects. She's had the opportunity to work in many different countries, which kind of aligns with her childhood ambition to be an international supermodel. So, join me in welcoming the hottest Chief Investment Officer in the industry, Gyongyi George.
Thank you, Leroy. What an intro. Thanks very much, and good morning, everybody. I'm here today to talk about investment themes. Some of the themes will be related to the main topic of sustainability directly, but everything about investments is about sustainability. If we talk about investing for the long term, which most of us do, we can't possibly invest for the long term without thinking about sustainability, things like climate change. And in thinking about the themes that I'm talking about today, these are the main themes we think in the next 1 to 3 years will really shape the global economic and financial landscape. It might not be 3 years, it might be 4, it might be 5. These may evolve, but we don't think materially these are really going to change as the main themes and topics globally. There we go. In investments and in terms of the 4 elements, we've identified 4. I'm sure that's not a surprise, foresight. We've got 4 themes. The first thing that we have is water. Surprise, 4 elements, 4 themes. Now we start with water. If we take a step back and we think about a wave has a cycle, and when it finishes its cycle, it ends in a break. And that break creates white water, and it creates a lot of turbulence. Where we are in the cycle, both economically and financially, is we're at that break. We're in the turbulence. Sometimes when you're in the wave, you don't know whether you're up or down. You don't know which way is up. There's different dynamics forcing you up and down. And that's where we are in terms of the cycle. That's the volatility we're all feeling as investors. We're finding globally, and some of the themes I'll talk about here will be global, but a lot of it really is here in South Africa too, in our local asset classes. If we think about lending standards, what we found is there's an overextension of credit globally. In terms of credit itself, there's more credit being extended, but the quality is deteriorating. So that really means that we're probably looking at some sort of credit cycle and the end of that credit cycle when you get deteriorating credit standards. Then if we look at asset classes, and if we talk about turbulence and conflicting messages, we're in the wave, which way's up? The equity market is telling you one thing globally, and the bond market is telling you another thing. So if we look at equities, and to a large degree here in South Africa too, are being driven by monetary policy. So the global easing, we had a small rate hiking cycle, and then it went back to cutting in the US. Monetary easing has really supported equity markets for the last 10 years. So we're not seeing too much stress in equities. In fact, we're seeing a lot of overvaluation, apart from certain markets like in emerging markets where you do see some value. But if we look at bonds globally, they're telling you a completely different story. Total risk aversion. We're talking about negative yields of $17 trillion. Now, in layman's speak, negative yields in Germany means you go to the German government, you lend them your money, and you pay them for that privilege. There's no textbook in any investment sphere that tells you that that is the right way to do things. However, that's the world we live in today. What does that mean? That means there's risk aversion. So bonds and equities are sending you different signals. And this is all against a backdrop of very low economic growth. We obviously experience it here in South Africa, pockets of growth, some places in the world, but globally, growth is a problem. So when you're in this point of the cycle, what you do find is there's lots of governments do respond, And people respond as investors. Now, you probably have two sets of investment responses. You've got the investors who are looking at this as opportunity, because there is opportunity when you see a lot of disparate signals. And then there's others that are looking for safe havens, the bonds that I spoke about earlier. So you've got a lot of different opinions out there where the investment asset classes should be. Some very bullish on emerging markets, for instance. Some saying, well, we need to hide in bonds because that's a safe place to be. The one thing we do know about where we are in this turbulence, the white waters, is that we do know in the break of the wave, is that we know that the past successful investments are not going to be the ones in the future. And whilst in South Africa we still have quite positive yields in bonds, globally, will fixed income protect you in the next cycle if there's a downturn? There is some question around that. Negative yields, how much further can they go? The second thing is, it's not all turbulence. You do then get calm water. So that I've talked about this as the 4 quadrants. There's 4 quadrants of assessment as an investor. You need to think about the opportunities because there are still opportunities for investment. We talk about low growth, we talk about negative yields, we do talk about many of the factors that we're concerned about in investments, but there are still pockets of opportunity. Emerging market debt, you can think about emerging market equities as well, where that is where growth is. There are possible opportunities down the line. After a credit cycle like this, you often find very good opportunities globally, not so much here in South Africa as an asset class. In distressed debt, for instance, you do want to be aware of interest rate sensitive investments, whatever they may be. You don't necessarily don't invest in them, but think about the interest rate cycle. These are unprecedented levels that we're seeing globally from an interest rate perspective. So if you are making global investments, and for most of us in retirement funds, that can be up to 30% of our investments, we need to think about that landscape. We can't use the playbook from the last 10 years or the last 20 years to project forward. We need to think about other options. And then there are your safer options. If you look at global trends, lots of people going to dividend-yielding stocks that have got growth in dividends, some sort of income protection. So the second theme is wind. I think you've all got the themes here. Wind. And there's a wind of change. When you get to this break in the wave, you generally get a change in market leadership, whatever that might be. You normally have certain agents in a marketplace, and often that will then change. What does that mean practically? Before 2008, we had banks did most of the credit lending. 2008 exposed a bit of a flaw in regulation, so regulation came along to help investors and help kind of shore up the banks, and then that led to central banks then had to step in on the lending. So we did have a market participant change there. It was very significant. That actually meant that we ended up with growth in private credit globally as an asset class, which hadn't really existed before, because now banks couldn't extend credit, but central banks did, but then there was also a growing asset class that hadn't really existed for investors. In this market participation, and we talked about low growth environment, we all know we have trade tensions. We hear about it all the time. I'm not telling all of you anything you don't know. But why? Well, the fundamental reason why is obvious. Low growth means that we have to clutch onto growth where we see it, and there's now a competition for returns. In a very high growth environment, globalisation is a good thing. In a low growth environment, you then start to try and find growth in pockets and keep your own growth. And we have very elevated, I spoke earlier about equities and bonds, the disparate message there. But what this really means from a market perspective is people are looking to other asset classes. And in terms of the market change and some of the structural changes that some of us miss in kind of the trends, globally and locally, the number of listed equities has dramatically decreased. However, economic activity doesn't. Businesses continue to be set up, financed. So what does that actually mean? That means there's been a bit of a transition into the private sector, private lending, private equity, private debt, because now the listed market doesn't necessarily always represent economic activity. So that is a structural change. We've seen a growth in passive, not so much here in South Africa, but definitely globally, at the expense of active. Passive investments has gone up. However, in a time of turbulence, we're in the break of the wave, the cycle's changing, active management can really help you add value in your portfolios. And we really think that that's not something that's going to be a temporary thing. You do need to navigate this turbulence. You need to understand governance. Sure, we'll talk a lot about governance today, but governance is key for successful investments. You need to be able to withstand your underperformance periods because we have to be mindful of behaviour. We all have behavioural biases. When times are tough, we want to do something. It's not normally the right time to do things. But active management can certainly help in this cyclical, relatively difficult, low return environment to add value in a portfolio construction. So the globe is the Earth. So now I'm on Earth. I'm sticking to my theme here. Just want to touch on the trade tensions that we're seeing. So we've had an unprecedented period of globalisation, 50 years. You could argue it reached its peak a few years ago, and that impact of globalisation had a number of knock-on effects. We did have a very large increase in global wealth, but that was very unevenly distributed. We also had a very, very low inflation environment as a consequence, because now the production capabilities went to low-cost producers and we ended up with dampened inflation. So now we are at the end of globalisation and we're now in a different period where you're seeing a lot more rhetoric around keeping things internally in terms of nationalisations, making sure that we have, and obviously this has led to the Chinese and the US in terms of their trade wars and the trade tensions. In the UK we have Brexit. This is a reverse of globalisation. This is the opposite. So you can't linearly predict, we had global wealth, it's going down. We had inflation, it's going up. Because this is very complicated. But what we do know is what we've experienced isn't going to be the same environment because now globalisation was the tailwind to that, and now we're getting the headwind. So we need to think about that investment perspective. Isolationist policies do have knock-on effects. We don't always know what they are, because again, the globalisation itself was unprecedented. And then this brings me to the next global subject, topic, consideration. China. So in 1990, China was the 17th largest economy, 16th of the size of the US. In 28 years, it grew 30 times. 700 million people came out of poverty in that process. The numbers are astounding. 700 million. There's got to be a growth opportunity there. Surely we should invest. What's going to happen? I will say that I have been in investments quite some time. My supermodel aspirations were a long time ago. And if I tell you that 20 years ago, if I'd said to any one of you in the room that China was the next best investment opportunity, I don't think I'd have found one buyer. I think you'd have all looked at me and thought, no, can't possibly be. And then I'd have quoted all the things we know today. I'd have said to you, right, there's 1 billion people. They want to buy things. There's a lot of labour. They're much cheaper than us making it here in the UK or the US. Don't you want to kind of direct your activities? And I'm not sure I would have convinced any of you on any of those metrics. Today, we sit in an opportunity. It's much more open. We think we understand China a lot more. It's not necessarily as open as all the other economies that we invest in, but there's got to be an opportunity there. However, this is the yin and the yang. With that growth comes a lot of risk, because we know it's not linear. We know that you don't just take the growth rates and say that's my investment return and it's going to exactly match that. There's going to be a bit of risk along the way. The global trade wars are obviously asking questions about how viable that risk metric is. How can you possibly assess what the impact of it all is? I'm telling you that there are certain unknowns around all of that that we obviously need to consider as an investment. However, from a macroeconomic perspective, you can't ignore China. And it's going to probably be volatile, but from a growth trajectory, that is where the growth is. And if you're a growth investor, investing for the long term, you've obviously got to consider it. It's very topical at the moment. We do see people trying to make single investments. From an investment perspective, I'd say if you've got an emerging market investment, you've got some China investment. If you add on extra China, be careful, because now you're doubling up on a risk that's embedded already in all of your portfolios. In fact, if you look at your global equity funds, if that's how you invest, they'll also have a lot of China. And actually, it's all actually a lot of tech. So that's another consideration. So that's just the health warning. And my fourth theme, and it's probably the most important one, and certainly it's the theme of today, is about sustainability. I reiterate, how can we all possibly invest for the long term and not be worried about climate change or good governance or any of the economic scenarios where impact is such a key and crucial factor? So sustainable investing, where it used to be a word that people used to say and then have very kind of little follow-through in terms of what people perhaps meant, and it means a lot of things to different people, it is a crucial, crucial theme, and it's actually just gaining importance. You need to understand the impacts of companies. I think what you'll find is there's going to be a divergence in the way that people invest globally and here in South Africa on this point. We do have a very narrow equity market in South Africa, so certainly from our view, and I think for most investors, it's about engagement, it's about understanding, it's about really making sure that you facilitate change. It's not necessarily about exclusion. However, when you look at the global economic equity investments, people are going more exclusionary. Filters, getting rid of stocks that have certain characteristics. That's just gaining in prominence. You see a lot of sustainable indices globally, subset into the US, some subset to Europe, that filter out certain activities of companies or certain governance structures, and that's just gaining in momentum. One of the key things that we know is that energy is being disrupted everywhere. Whether it's an energy for your car, whether it's solar, whether it's all the renewables that we talk about every day here in South Africa, we know that energy producers are being disrupted. We know that that's going to have an impact. But I don't think we all always think about the impact. We think about the company, and I'll use the company, but this is no analysis of the company. We don't invest in companies specifically. But if you take an oil company like BP, so BP is obviously in a phase of disruption, oil company, very unfavourable climate perspective and lots of different impacts around that. However, if you find a cheaper energy than what you're using at the moment from that perspective, a company is going to benefit from that. That's the opportunity. Who are the winners? Because we often concentrate on the losers in this space and we identify the companies we know are under threat. But there's obviously the balance. We talk about nature, there's always balance. There will be the winners in this. There will be the companies that actually succeed. There will be the companies that thrive in this environment that are at the head of that technology. And it's about making sure that you incorporate that in the analysis. Again, it's going to be a different approach where we sit here in South Africa to where we sit globally. However, it's all focused on the same thing: sustainability, understanding long-term forecasts, really thinking about the long-term future of your investments. Now, a lot of my colleagues and my fellow presenters will talk a lot more in depth about sustainability, impact investing. But in thinking about impact investing, that is something that is available to most retirement funds. It is certainly something that encourages sustainability on a number of levels. And if you have the budget, both globally and locally, from a resourcing perspective or a research perspective, thinking about that is one step in terms of the portfolio. As I said, in South Africa, we have a very limited equity market. Screening out, making sustainable equity portfolios, probably pretty tricky. However, we can encourage sustainability through investments in different ways. And that's probably through the private markets, because that's largely where you'll see a lot of that impact coming through. So there are 4 key themes. The one thing I didn't say at the beginning, which is key for all of you, is all of these are interlinked. Because that's investments, and that's actually the way that financial markets and economic models evolve. So all of these are interlinked in one way or another. I mentioned the China trade wars, the US-China trade wars a number of times. This is obviously affecting growth. This is creating the turbulence in the wave breaking. But the turbulence was already there. We were already at the end of the cycle. We were already talking about interest rates being too low. We were already talking about global growth prospects being very low. And we were all looking for yield. And my conclusion across the 4 themes is that whilst these are challenges, and we are at the end of a cycle, investments are cyclical. And at the end of the cycle, there's normally an opportunity. Is the opportunity, a lot of what we're going to talk about, impact investing, is the opportunity thinking about the winners in this sustainability drive? There's going to be an opportunity, but it's in finding the opportunities and partnering with the kind of management skills that can get to it, because it's not always easy. We can all buy NASPers, but it's not always easy to make other investments. It's about thinking about where the opportunities lie today, because I think we are in an environment that's very difficult, low real returns. We do find that investors are looking at their mainstream investment returns and they're very low. However, in thinking about these themes, these will all create opportunities for investments. And some of them might be quite long-term. Sometimes sustainable investments do take a long time frame to actually arrive from an investment return perspective. However, if you're a long-term investor, these are the things you need to be thinking about within portfolios. Certainly we're thinking about them, and we think that these 4 themes, if you approach these in the right way and think about the opportunity sets, this can be really good for investors. Thank you.
King, we appreciate the insights that you've shared, and we've got a few questions that have just come through on the portal. As I mentioned earlier on, there's a portal called Huddle. The email links were sent to you, and you should be able to log in through the links that were emailed through to you. If you do have any challenges, the team at the back will be able to assist you with that. But very, very quickly, we've got 2 questions that are posed here for Gyongyi to respond to. Can you share your views on private debt as an asset class, especially high-yield debt in South Africa, considering our local environment and global late-cycle growth?
Oh, that's a good question. We're positive, private debt, but you have to be selective. We do have economic challenges in South Africa, but we've still got very good companies that are hungry for capital. And as I mentioned earlier, the banking regulation has made a few avenues not available to companies anymore. So we're positive, but selectively. And I think in terms of when things are really good, people kind of do a very broad spread of investments because everybody is benefiting from the uptick. In this environment, you do have to be very selective. But private credit globally is a trend for all the reasons that I've just explained. Fewer equities to invest in. Banking regulation globally is making it very difficult to get financing, so people are going the private route, and that's for all of us an investment opportunity.
Last question. Is active management the right approach to navigate the 4 elements?
We definitely think so. I think in this kind of environment, you can also, from a perspective of passive investment, you're going to see all the highs, because obviously you linearly track up whatever asset class, but you're also going down with that asset class, and that's the pain point for investors. And in active management also, it's about filtering out investment. We're not in an environment where all indices, all companies are going to benefit. So even if the equity market goes up, it's going to be very selective, the companies that are driving that. Because of the economic environment, low growth, you're talking about selective companies that are able to capture that bit of growth that there is in the system, whatever that might be. So we're big believers in both. I mean, we use both in our portfolios. However, from a turbulence perspective, from a risk perspective, active management can help you filter out. We also have an overlaying view that the one thing in passive that you don't get, which you do get in active, is you get that overlay of ESG requirements and monitoring, and that's certainly going to be a benefit, because when you look in an environment within which we sit, you do have some companies that are poorly governed do get exposed. They don't have the economic environment to lift them, and that's where active management can really help you.
Thank you very much.
Thanks, everyone.
A big hand for Gyongyi King.